Imagine a time in American history when thousands of different banks, sometimes even hundreds within a single state, each printed their own distinct banknotes. How could people possibly trust these varied pieces of paper as legitimate currency? During America's free banking era, from 1837 to 1863, the answer to whether all free banking notes were backed by state bonds is no, not every single one. However, the vast majority and indeed the defining characteristic of this decentralized system was precisely this requirement for some form of bond backing. The core mechanism of free banking laws, adopted by individual states, mandated that banks wishing to issue banknotes first deposit specific types of approved securities with state banking authorities. These securities predominantly consisted of state government bonds, with varying degrees of acceptance across different states. This requirement was intended to provide a crucial layer of security for note holders, ensuring that if a bank failed, its notes could theoretically be redeemed, at least partially, by liquidating the deposited bonds. The idea was to prevent overissue of currency and to maintain public confidence, though the actual effectiveness varied greatly. For merchants and everyday individuals, this meant that the real value of a banknote could fluctuate based on its issuing bank and the perceived financial strength of the state whose bonds served as collateral. A note from a bank in a fiscally strong state might trade at or near par, while a note from a bank in a state with questionable finances could be discounted significantly, sometimes losing a substantial portion of its face value, particularly when from the issuing institution. This system also gave rise to the colorful term wildcat banking, which refers to banks established in remote or inaccessible locations. These wildcat banks would intentionally make it difficult for note holders to present their notes for redemption, often backing them with easily acquired, low-quality bonds. The fluctuating value of these depreciated notes added a layer of complexity and risk to everyday transactions. Understanding the bond-backed nature of free banking notes reveals both the innovative attempts to create a stable currency in a rapidly expanding nation and the inherent weaknesses that ultimately led to widespread instability and fraud. These experiences laid critical groundwork for later federal banking reforms, shaping the financial landscape we know today.